Let's talk more about inflation and the Fed. We just got that news about Bostic planning to retire at the end of his term in February. Joining us this morning here at Post 9 is David Zervos, Chief Market Strategist at Jefferies, and of course a CNBC contributor. Good to see you, David. Welcome.
Good to be here, Carl.
I'm going to guess you're not too worried about the hand-wringing about consumer much?
You know, that's probably what you would think, but I am getting a little worried, believe it or not. And I think I'm tracking the labor market a little bit more closely, and I'm just not liking what I see. And I think we've got a couple of problems, Carl. One, monetary policy is too restrictive and has been too restrictive for a while, and I think that's a battle I'll still continue to fight. But more importantly, it's the AI story that you cover every day and the confidence that's kind of shaking. I was particularly struck by the interview you guys did or was on the network with Barry Sternlicht, a friend of mine, and, sort of point blank kind of saying, I've got this program, they're $30 a month that makes 15 or 20 people redundant at my firm. That's what we're hearing, and we're seeing it, we're hearing it, we're feeling it. I think workers are starting to get a little bit of a confidence issue, and I'm seeing the data, the revisions we've had, the big revisions, the 1.5 million jobs we revised away over 24 and 25, and the weakness that we have today, Challenger and ADP. I don't like it. So
you think Michigan is an accurate reflection right now?
I'm not sure. Michigan's got weird stuff in it. Yeah, I throw that away. I like Challenger. I think ADP does a decent job. I think the revisions are probably the story of the year in the labor market. We've dismissed the 900,000 in 2024 and then the 400 and change thousand for the early part of this year. That's a lot of jobs. We had much more productivity growth than we thought. We had much less job-fueled growth than we thought. And I think that's pointing me to a couple of culprits. The good side, technological advance. That's always great. The bad side, policy's just not stimulative for demand at a time when the job market's weakening.
But if the big problem is really that Barry Sternlicht can do with AI what he can do with 15, 20 people, then easier monetary policy will not cause a wave of hiring.
But it will stimulate sectors that are interest rate sensitive, Barry's in particular, the real estate sector, and he would love to see reasons why that picks up and he can hire more people potentially.
Well, that's the question.
He could hire more people potentially in the mortgage finance world, maybe in the construction world, in places where the AI isn't going to happen. I don't think we're going to have AI robots banging nails into roofs on houses in Austin, Texas, and Miami, Florida. So let's get the interest rate sensitive sectors moving. Let's get that job creation machine moving. And that could be an offset to some of this other stuff. I think we're fighting an old battle, Sarah. We're fighting this inflation battle from the past that really is a price level battle, one. It's not an inflation battle, as you said in your opening segment. And we're kind of missing the forest for the trees on the labor market. I'm really optimistic on the returns for capital, earnings, S&Ps.
And probably stocks.
And stocks,
yeah.
and I love that. I'm kind of worried about the swath or the path of creative destruction that all of this productivity is going to leave in the labor market, and what that means for more Tuesdays like we had last week in New York, and how voters go, well, wait a minute, I don't feel part of this. And as the Secretary of the Treasury has said, I think the number is something like 88% of all stock value is owned by 10 or 12% of the population, kind of consistent with your B of A chart earlier. That's got to change. That people have to feel part of this productivity story. Otherwise, we're going to have a bunch of Luddites burning the machine.
So the Journal did a piece about the political left beginning to push back on the AI build-out.
Yeah.
You think that picks up steam? I mean,
do.
This is an argument.
I do.
They come to town. This is going to take your water, it's going to jack up your utility bill, and it might put you out of work.
Spanberger in Virginia, she was campaigning on it in Virginia, which has been a big data center play. I think it's real, and I think the administration got a notice on Tuesday that it's real, and we're going to see hopefully some pivoting. Hopefully the Fed, remade as you've discussed here with a new governor and a new chair, will get that notice. And I do think folks like Kevin Hassett, a real supply sider in the way he thinks, will be sympathetic to the idea that this is supply side driven growth, which really is disinflationary. And it's very important to think about these labor market consequences, which could be negative.
It's so obvious to you, and yet there is real debate inside the Fed right now, and dissenters and even Fed Chair Powell, I know he was trying to reflect sort of the discussion at the Fed, said that December's not even a certainty.
You know, it doesn't surprise me. The Fed underbelly, the staff, is made up of Keynesians and demand-siders. They're not really supply-side thinkers. The good news, we have some changes coming. I think those are more supply-side driven. But it's going to be hard to move that Fed. By the way, Greenspan, I think, was really at the forefront of this in the 90s when we had, you know, the productivity miracle, the new paradigm, a lot of supply-side thinking. There it wasn't as just job destructive, though, at that time. Even though people talked about it, it didn't end up being that job destructive. This productivity story feels a little
But are you not
at
all worried that the bulk of the inflation still is in the services part of the economy? And if they do go easier, there is this fear that they can reignite. I mean, if they stimulate demand, then they reignite the services inflation, which is really what the trouble they got into in the last few years.
I think a lot of that core number is in housing services. A lot of that has not been coming as quickly as we thought, but is in the pipeline and is really going to hit in 2026. We're seeing it in a lot of the micro data. I don't worry about it. I mean, I'll always worry about it in the back of my mind, but I think it wouldn't stop me. And I always think, you know, Sarah, if for some reason we overstimulate a little bit and we start to see it, we know how to fix that problem. It's pretty easy.
Yeah,
we stop it, or we raise some rates and slow it down, and that's a problem that I think we know how to deal with.
And you think the market can handle the back and forth?
I do, and I think the market never got its inflation-anchored expectations dislodged when we were at 9%. I mean, we had an inverted curve, five-year forwards, in the break-evens, all that stuff just stayed anchored. We all said this is coming back down, and by and large, it did. We're at 2.5 to 3. A heck of a long way coming down from 9. Sometimes we forget how far it's come down because we get stuck on price level. But I think it's really hard for me to see a worry at the Fed about dislodging anchored inflation expectations when a 9% inflation rate didn't dislodge it in the first place. So is 3 going to dislodge it because we went from 2 3/4 to 3? Seems kind of silly to me.